Awesome. Hey, good day, everyone, and a very warm welcome to our banking industry, debt counselors, and their respective teams. It gives me great pleasure to introduce myself as the DC Relationship Manager for Consumer Friend. Looking forward to engaging with you all. A very interesting topic for today's discussion, the state of the consumer credit industry. This is indeed a very appropriate topic, especially with the ongoing pandemic and the recent civil unrest that affected our economy. I'm very excited to introduce to you our key role players in the banking industry who forms part of today's panel discussion. A very warm welcome to Denise Hartley from F&B, who is the Chief Operating Officer for Retail Collections, looking after debt review.
Hi, guys.
Hi, Denise. How are you doing?
Good, thanks. How are you, Drisha?
Good, good. Great to have you on board. Welcome.
Thank you.
Next up, I'd like to welcome Roxanne Fitzy, who's the Legal and Stakeholder Manager for Standard Bank. How are you, Roxanne?
Morning, Drisha, and morning to everyone on the line. Lovely to be here. And thank you to Consumer Friend for organizing the event.
Great. Welcome, Roxanne. Our next panel discussion is Mohammed Lahir, who's the National Manager for ABSA, Retail and Business Bank. Welcome, Mohammed.
Morning, Trisha. Morning, team. Looking forward to today's engagement with everyone.
Great stuff. Thank you, Mohammed. And last up, we have the Head of Debt Counseling from Nedbank, Laureen Kempt. How are you, Laureen?
Morning, Trisha. I'm very well, thanks. Thanks for asking. And yeah, quite excited to join and to be back in the debt counseling environment after some time that I've spent in other areas in the bank. Great,
great. Welcome. All right, guys. So it's great to have you all here. Thank you so much for taking the time off your busy schedule for joining us. We have a few questions planned for today's discussion, and I think our debt counsellors are also very eager and excited to have you guys on board. Thank you so much. So my first question is to Denise. Has the profile of the client entering debt review changed since the pandemic?
So, Drisha, it has. It has slightly. So, historically, debt review has always been for middle and upper class, right? I mean, we know that from many years of being in debt review, and it has to do with people being more financially literate, knowing more about what their options are and that kind of stuff. But as coming out of the COVID period, well, hopefully, what we've seen is an even bigger shift. So the portfolio tilt has moved even more towards the sort of middle, mass and then and middle and upper income groups, and a decrease in the lower groups, lower income groups. What we're also seeing is that the debt review, the inflows into debt review have definitely slowed down, but the people that we're seeing coming in are coming in with a bigger exposure. So less people than we would have seen historically, but with bigger balances. So guys with the bigger houses and the big cars and that kind of stuff. And there were always a few of them, but we're seeing more of that starting to come in, where people are really struggling, I think, to maintain their level of expenses that they previously were able to.
All right, no, great. Roxanne, would you say the same is happening at Standard Bank?
Certainly, Trisha. Denise makes some good points. I think one thing we can all agree on, though, is that whoever is coming into debt review, whatever category or income earning group they fall into, the common theme and the commonality is that these consumers are over indebted and that we're here to help them. So that is still the common theme. That's what debt review is catered for. Yes, it might be a wider net now, and more people might be finding themselves having to come to debt review as a debt relief mechanism, but that's still the commonality.
All right, that's good. All right, Roxanne, are the consumers under debt review mostly over indebted with loans or credit card debt? What would you say?
So also difficult to say. Traditionally, though, most of the book in debt review always makes or the number at least, is your unsecured debt. So card usually being your largest product based on volume, and then obviously your home loan still being the biggest in value. So I will say that.
All right. Any other comments from our panel regarding that? What would you say? Mohammed, I can see you want to say something.
Yeah, it's a tough act to follow. I think the two ladies before me has covered it quite comprehensively, but definitely, I mean, we do note a more distressed customer entering the debt review space. I think that's the general theme of what we're seeing at the moment.
Okay. All right. Mohammed, what are the banks doing to address the outstanding balances?
Drisha, I think maybe the question is, what are the banks not doing to address the outstanding balances? Now, look, I think perhaps let's start with outside of debt review. So I think outside of debt review, we all know the banks initially at COVID time did quite a bit to create very bespoke solutions for clients. Payment relief was extended from all the big banks and even some of the smaller financial institutions. I mean, to the point where just about most consumers that were impacted were granted up to 3 months relief where they didn't have to provide any repayments back. I think since the looting, the banks have engaged again through the Banking Association with the various governmental associations to try and craft up some sort of relief package. And I think we're still busy with that. I think perhaps smaller things, but things that make an impact are like the scrapping of SAS switch fees at ATMs and the rest of it. And that's a small relief, but I think it all adds up, particularly for the consumer in debt review, right? If we bring it home to the debt review space, I think obviously each bank will act within its own credit risk appetite, and every matter will be considered on the merits. But I think the general theme is approach your bank before the consumer defaults on the agreement. And it's much better to have the discussion prior to the discussion we have around, please reinstate my terminated debt review account or my client's terminated debt review account. Rather proactively engage the bank, and I mean, there's a well-detailed procedure we've worked through CIF and the regulator around the 17.3s and the change of circumstances. And I think that gives you all the detail you need to proceed. Essentially, it's prove that your client's been impacted by external circumstances, craft a plan to bring your client back up to date over a short period of time, submit that to the credit provider, and if it's reasonable, I think most banks will accommodate consumers considering what's happening in the broader scheme of things.
All right, no, that's great to know. And Denise, for F&B, how is this addressed with regards to your outstanding balances?
Yeah, I think, Trisha, that Mo made a couple of very good comments, and I think that's very important. And it's important for both consumers in debt review and outside of debt review. So we are all aware of the fact that we're under tight economic circumstances, and certain things have been going a little bit sort of funny lately. So we've got the pandemic, and then we added some rioting and looting and people losing businesses, and then the impact on jobs and that kind of stuff. But we've got day-to-day stuff. So yes, interest rates are low at the moment, but cost of living is just increasing, right? It's just increasing. And I think it's very important that clients, customers, consumers are aware of the fact that you can approach your bank, and you should proactively, whether that's through a debt counselor, whether that's you going to your bank and saying, guys, I'm experiencing trouble. All of the guys in this forum, at least, but most of the smaller guys too, do have some sort of plan to assist clients for short-term, long-term, assistance with their outstanding balances where they do get into difficulty. It's always best to proactively address any kind of situation and not wait until, the sheriff's knocking on your door. And a lot of consumers do still tend to do that. You do a little bit of an ostrich thing. It becomes so overwhelming that you don't deal with it. But generally speaking, banks are prepared to work together with their consumers to assist them. Like I said, through debt review 17.3 process, as Mo mentioned, with regards to the unrest relief, we got a little thing on our app. You can apply for your unrest relief. There's, there was COVID relief. There's, so we really are looking to assist our consumers, because we're all aware of the fact that these are tough times, and we're going to feel the economic repercussions of this for a couple of years still. So we all just have to work together and figure out a way to get through it and navigate through it.
Great. So you said you've got something on your app with regards to an unrest relief as well as a COVID relief to assist consumers. Awesome.
Yes.
That sounds great. All right. Just to let you DCs know as well, we are taking questions towards the end. So if you want to send it through the chat, Shannon will be screening the questions, and we will take it through towards the end to our banking panelists. All right. My next question is to Laureen. How has the recent civil unrest affected the banking industry?
So, Trisha, from our side, we were mostly affected in the KwaZulu-Natal and Gauteng areas, obviously. The looting itself and the civil unrest definitely had an impact in terms of economic growth. The damage to physical assets, we've had a lot of our branches that had to close down for basically 2 or 3 business days. We had to close down most of our branches in the KwaZulu-Natal area, which has obviously put a bit of a hold for the 3 days, just in terms of business and clients being able to actually visit those branches. And then we also were affected in terms of physical damage to branches. So, when they were going into shopping centers, they were also causing some damage to the branches itself. We have seen a bit of an increase in terms of change in circumstances, our 17.3 applications specifically after the unrest. People that were all of a sudden not able to go back to work. The biggest impact was in our self-employed industry, people actually losing their businesses as a result of the looting. And yeah, I think just in general, in terms of law and order and the protection of citizens, people were feeling uneasy about that. And yeah, a little bit uneasy about what is the future in terms of South Africa, and that has obviously also had an impact in terms of investing and economic activity in South Africa as a whole. So yeah, there was a couple of things that we've had to implement from a Nedbank perspective to make sure that we assist clients as much as possible in terms of that. And like I said, especially in the self-employed market. But what was however, very positive about it was South Africans actually taking hands. And it was quite encouraging to see all of the images of South African people actually, going and cleaning up areas, as well as people just literally standing together in terms of protecting their neighborhood. So I do think on the one side, yes, it was quite a negative impact. On the other side, it was actually quite cool to see how South Africans can actually stand together. So, and what we are made of and how we put together. So, yeah.
Yes, no, absolutely. It really brought communities, people together. And I mean, we thought the pandemic was something huge. And yes, it is. But when this hit us, it was sure, this is like, where did this come from? But yes, you're right. It just shows the togetherness of people and working together and just trying to combat things like this that happens. Roxanne, would you like to comment with regards to the civil unrest?
Sure, Trisha. As Lorraine pointed out, there was lots of damage. No one was exempt in the industry, in the country. It hit hard everywhere. And yes, at least there was encouraging parts to it. As South Africans, we always see the silver lining to everything we have to. Yes. But I mean, I know BASA had a press release which actually disclosed that the banks in total as a whole, lost about 119 million rand due to things like damaged or stolen ATMs, vandalized branches, things like that. So, I mean, we weren't exempt either in terms of the damage. And I mean, we also had to close branches. I mean, no one could expect people to have gone in during that time. The economy stood still. I think people were very nervous. It was an awful time that a lot of people had to endure. And I think we're all just glad that it's behind us. I know Standard Bank in particular felt very passionate about the relief efforts in KZN and gave a donation to the tune of 15 million towards the relief efforts down there. So, and I'm sure that money was used very well and to the people who needed it most. But just glad that we've been able to come out of that stronger and more unified than ever.
Yes, well done, well done. Thank you
Thank
so much. Okay, Denise, what are your challenges with the debt review process itself, and what minor changes can the debt counselors do to assist?
So I think that the big problem with the debt review process, and it's gotten a lot better over the years, but I think communication still remains a little bit of a niggle. And we just need to make sure that we start dealing with issues, I think, a little bit sooner. We have a tendency, and the fact of the matter is that banks make mistakes. Of course we do. We're human beings. Somebody captures somebody wrong. Debt counselors make mistakes too. PDAs sometimes also go off the reservation a bit, but I think that the thing is identifying these earlier on, you know, as soon afterwards as possible, and trying to address it then is a little bit easier than coming to the end of the process and then trying to figure out what is going on. So I think that at CIF, we're busy working on the annual review paper, and I know it's a very hot topic, and some of the debt counsellors are like going, "Are you guys kidding me?" But I do think that, and I know some of the debt counsellors on this call actually do it quite well. Romy is going to stick up her hand and say, "That's me." But the fact of the matter is that to just look at the accounts every now and then, just take a touch point, just make sure that things are still working well and still going well, so that we don't, when the wheels fall off, then have to run back and try and fix something that went wrong 2, 3, 5 years ago. So I think that's one of the things that we just still need to do a little bit better in the debt review industry. Other than that, I think most of the stuff, we all sort of know now what to do and where to go, and we've all been here before, right? So we know how terrible it was. So I think it's relatively a well-oiled machine, but there's small little tweaks that we can do to just make the customer experience and always just make sure that we don't have this big battle at the end, or end up in litigation because we're saying, well, we didn't get the payment, and the DC saying, but we sent the payment, and then everybody's now trying to figure out what happened.
Denise, I think we lost you for a second. Okay, we're back.
Sorry, somebody was trying to call. I was getting a team
No problem.
call while I'm in a Zoom meeting.
It's fine, it's fine. All right, any other comments from our panel with regards to the debt review process?
Perhaps I could come in.
So
Sorry.
for
Okay,
it, Roxanne.
Roxanne, you'll go for it, and then Mohammed thereafter.
You could see this is a question we are eager to answer.
Yes, great.
Denise hit the nail on the head, as always. Communication is where the inefficiencies do come, is the miscommunication between ourselves, DCs, PDAs, courts, wherever. And that's where we can tighten up. So I think from a credit provider point of view, you know, it's important for us to maybe understand some of the challenges that the DCs experience, you know, that prevent them from, you know, coming back on proposals or counter proposals, or, you know, following through on that process, as well as coming after the fact and providing court orders. You know, if it's a past set down in the sense of the court orders, the court date has come and gone, but we haven't heard any feedback, we didn't necessarily oppose it, we rely on the DCs then to come back to us to tell us what actually happened. Otherwise, those accounts stand in limbo. Also, with regard to court orders, some of them only solve in terms of a cascade, so that the smaller debts get paid off sooner, and then there's more to go towards the bigger debts later on. But if we don't get the cascade together with the court order that was made part and parcel of the court order, then we can't restructure accordingly, and then the debt actually doesn't solve on paper, because it's dependent on the increase in the installment for that to come through and to solve. And as I said, just in general, court orders that do solve, because we know there was that recent SCA McLaughlin judgment that came through that gave a lot of clarity within the industry, in the sense that if a court order doesn't solve, the restructure rearrangement order doesn't solve in the end, that or amount to the full satisfaction of the credit obligation in the end, then essentially the courts have ruled that those orders are void ab initio. So I mean, that's just a very important point to drive home, is that we've got to deal with restructures that actually solve at the end, because otherwise, we're not helping the consumer at the end of the day. And they're going to sit with an imbalance, or an account that just gets bigger and bigger. It doesn't actually get smaller. And that's not the point of debt review. We're here to rehabilitate consumers fully, and to then let them back into the credit market. So those are just a few extra points that I would like to add. Just things that would make our lives a lot easier from our side. Obviously, it's a give and take process, and we're also open to suggestions as well, and we welcome them.
Lovely. Thank you so much, Roxanne. Mohammed, you wanted to say something?
Yeah, I think Roxanne covered most of it, but I think again, general theme is that we just engage more proactively. I do note that in the chat there's quite a few questions around the 17.3 process. Maybe if we can just shed a little bit of light, so that we don't spend too much time on it later on in the Q&A. So look, the 17.3 process, Mr. Shabalala, I think rescission is perhaps not the correct. So if you reach an agreement with the credit provider, the ideal would be that the court order be varied, not actually rescinded. So you approach the court, ask the court to vary the order in terms of the new agreement that's been put in place. There are certain credit providers that are not that don't actually require the rescission or variation of the credit agreement. For some credit providers, I think it's sufficient if the new signed final agreement or agreement that's in place be annexed to the court file. For others, I think they'd prefer the variation of the granted court order that's in place already. So I hope that kind of provides some sort of clarity.
Okay. Thank you, Mohammed. Thank you so much. All right. So our next question, Roxanne, is to you. What recommendations do you have for the industry to make things simpler and more efficient?
Thanks, Tricia. Well, I think we've touched on quite a few. One thing that we would say is that we found it's always easier and less inefficiencies and confusion when we seem to be working off of similar platforms, off of one platform. So we're very excited with the enhancements that are due to come to DHS, especially from a credit provider point of view, in the sense that we'll have more access or viewer rights or things like that. I think that will do away with a lot of the miscommunication or lack of information between all the parties. So definitely common platforms, common systems, DCRS being utilized more, those sorts of things that are fail-safes and lead to greater efficiencies within the process. Denise has already mentioned annual review, which again, it does seem burdensome for a debt counsellor to have to look at their books every year. But the benefit to that is that you can see that if, for example, something isn't solving and the balance is increasing, it's so much better to pick it up within the first year or two than to be 10 years down the line, balances have skyrocketed, and only pick it up then. It's a lot easier to deal with from all sides and to fix at the earlier stages. Also, I mean, as we said before for the previous question, communication and also speed to execution, in the sense of, if we at proposal stage and we don't finalize, and then a court application isn't filed at court, and we then terminate, and then it goes all along the line. Usually a lot of the credit providers, well, obviously we have to give notice of termination, but even in addition to that, some credit providers try and reach out to debt counselors again and say, what happened? Was there perhaps a missed payment? Did we maybe not receive the accepted proposal, something to that effect, to try and prevent it from going into the various product areas and then being litigated upon, and then incurring those extra legal costs, because also harder to then reinstate and bring back into debt review at that stage. It shouldn't be a fact of having to wait till the last second before the vehicle's been repossessed to then suddenly want to negotiate. So I think the good faith, that's where that comes in, is to from the start have open lines of communication and to resolve problems as fast as we can.
Perfect. Thank you so much, Roxanne. Laureen, would you like to comment from Nedbank side regarding that?
Sorry, I'm struggling yet to find the unmute button.
That's
I
fine.
think Roxanne has covered it very well in terms of that. So yeah, I don't necessarily have anything additional to add. She spoke about communication. She also mentioned, that reinstatements is sometimes something that's a bit more difficult. And yeah, that's pretty much it from our side. I also think maybe one last thing to add is just in terms of the 17.3 or change in circumstances process, that the debt counsellors communicate with us upfront so that we can see how can we assist, because we definitely all in this together, and the way that we can assist clients, if it's to their benefit, it will also be to our benefit in terms of getting those arrangements in place.
Excellent. Thank you so much. All right. Mohammed, what do you see when you think of the future of debt review?
Well, I'd like to say the future is bright. I think Denise made the point earlier that we had a lot of teething issues. I mean, we're only 10 years, just over 10 years old as an industry. I think, as the courts put it, we don't have the greatest piece of legislation. But I think as an industry, we've worked through those teething issues, the many fights and hugs and kisses and all the fun things that came in between. I think we got to a point where we've got a process that works pretty decently. Where it doesn't actually work, we've got guidance from the regulator. And I think of late, the regulator's been a lot more involved, a lot more hands-on, willing to come to the assistance of the industry. I think CIF is something that's starting to work, albeit slowly and steadily, but there is some fruits that have come out of there. I think we all know that debt intervention is gonna pop by quite soon, and I think that's going to assist us as an industry and alleviate that burden of the lower income consumer that we sometimes struggle to house and accommodate in the debt review space, right? So we're hoping that will be a success and that flows smoothly, and that kind of makes it easier for us as debt review industry as well. I think we must continue the engagements. We must continue working with each other. I think whoever still has the mindset that it's credit provider versus debt counselor, I think that doesn't exist anymore. Maybe in year 1 and year 2, 2008, 2007, but I think we've come a long way, and I think we're headed in the right direction. So more of the same, I guess.
Yes, no, definitely. I agree. It's best that we work together, the credit provider and the debt counselor, in the best interest of the consumer at the end of the day. So it's always good to work together. Any comments from the panel with regards to that question?
Perhaps I can just come in there as well, Tricia.
Thanks, Roxanne.
Thanks. Also, something that we would love to see from our side is the consumers being more informed of the process and their rights and duties that come with coming into debt review as well. So, we still find that there are customers that come in and they say to us, oh, well, we were just on a phone call with someone who said they can reduce our monthly installments, and it's just a consolidation. And we had no idea we were entering the debt review, and the next thing they know, they flagged and they can't get credit, and they can't and now, especially with the Roots judgment, the Van Vuuren Roots judgment, making it so much more difficult to exit debt review, in the sense that customers can't voluntarily withdraw from the process anymore. Then we're in quite a fix, because we've got someone who didn't actually know what they were getting themselves into, and it's very difficult to let them out. So that is a problem we're encountering, and I think having consumer education, not just the people that are in debt review, but the population that are outside, if there can be more knowledge or more understanding about what it entails, and as I said, not just the benefits that come from coming into debt review, but also the responsibilities and the duties as well. That would be an important milestone, I think, to come in the future as well.
Awesome. Thank you so much, Roxanne. Right. And then we have the last question, and that's to Laureen at Nedbank. Do you have any success stories that stand out to you about clients who have gone through the debt review and subsequently credit worthy again? It's just good to hear these success stories.
Thanks, Tricia. So yes, we definitely have lots of success stories to tell. I quickly had a look before the webinar, just in terms of our stats. So we are currently sitting on the Nedbank book. About 30% of the clients are rehabilitate through the process, which is really a big number if you actually think about that. And that was just providing a snapshot at a particular time. So yeah, I do believe the debt review is a far better collection process than everybody going out trying to recover their money through legal processes or any other collection mechanisms. So I always tell all of my colleagues in Nedbank that they should rather send the accounts into the debt review area, because we are doing a good job, and yeah, and the clients are willing to pay. So why not put it through this process? It's a far better way of actually getting the money back, and it's also a way that the consumer is also protected in the process. So yeah, a big portion of our book are rehabilitated, and the clients are actually going back into the market. So yeah.
Great, thank you so much.
Very much of a success story.
Lovely, well done. Any comments from the other banks with regards to success stories? I'm sure you all have the same, right?
Yeah, I'll go just pop in here quickly. So for me, I think that the success story is the debt review process. So we get between 150 and 300 clearance certificates a week. And that is just phenomenal when you think about it. So yes, there are drop-offs, and yes, there are terminations, but I like this question because what it does is it highlights the successes. And I think it's very important for us. Sometimes we're so busy trying to sort out the chaos that is our daily lives for both debt counsellors and credit providers, right? Like to just take a moment and just say, we've helped so many people. It equates over the years to thousands and thousands of people who were lying awake at night going, oh my God, I don't know how I'm going to look after my family, how I'm going to take care of the things that need to get taken care of. And we've helped these guys with a solution, a repayment, and a way to come out the other side better and more comfortable and more aware of how to manage their finances. And that's a big part of that is down to the debt counsellors who have to hold the hand of these consumers through these processes. So I think from a credit provider perspective, we also just have to acknowledge the wonderful work that debt counsellors do in assisting consumers to come out the other side and be more financially aware after that.
Yeah, I think it was so rewarding in my career as a debt counsellor as well, to see consumers actually paying off their debt, being rehabilitated, and going out there and buying assets like a home or a vehicle after debt review. So that was just truly amazing. It's so good to see that. So yes, well done, guys. All right, so that concludes the questions that I had for this morning. We're going to now take the questions from the debt counselors. Shannon will now take over. I think there is a few questions. Obviously, we'll go through a few. Those that we can't go through, we'll answer via email. All right, so Shannon.
Hi, everyone.
Over to you.
Right, we've got a few questions here. As Trisha mentioned, we will get to all of them. I'm just going to ask a couple. So the first one says, some consolidation loans are over R1 million for over 10 years. We also need to get consumers out of debt review faster to re-enter the credit market. How do we approach DTI to reclassify long-term debts to address the longer terms of loans and vehicles? Who would like to answer that?
I'll take that one. So we have, as Barca, we've definitely done some work, and Roxanne and Mo and Laureen can jump in over here. So we have been doing some work around that. How successful we have been, I'm not entirely sure. But the fact of the matter is that unsecured loans do have longer terms, and vehicle loans for sure have longer terms now than what they did at the time that we came up with the rules and that kind of stuff. So we have been having some engagements. We have also proposed changes to the DCRS system, specifically with regards to vehicles, so that we can make sure that we can cater for the amount of vehicles these days that have residuals and the longer terms that we're offering, so that we can give the clients the benefits of the DCRS proposal while catering for the longer term loans.
Sure, perfect, thank you. The next one says, the 17.3 for COVID was only available for 3 months. However, we have been under lockdown for far longer. The banks have not accepted more than 3 months. However, how are consumers that were not working for more than 3 months supposed to navigate this?
So maybe I can jump in on that one. I see a lot of questions in the chat on the 17.3 and the process related to it. So I think, again, I'll reference initially at the outset, I'd like to reference that industry document that we've worked on, and I think that pretty much outlines the process, right? So it's the variation of the order. Yes, I think we fully appreciate that there is a cost entailed to this, and that's why many or some credit providers will allow for merely the new agreement to be placed in the court file and stamped by the court. I think from an ABSA perspective, that's something we certainly do. We accommodate that the consumer and that he doesn't need to incur those additional legal expenses to actually have the order varied. In terms of the indulgence provided, I think, we do provide concessions for up to 3 months, depending on the impact of the consumer and what's happened. I think when it goes beyond 3 months, we got to kind of ask the question, is this viable still? Is the client still a candidate for that review? I mean, surely a consumer that indefinitely has no income, perhaps that review is not the best fit for that consumer. And I think we need to start looking at alternatives. I think the insistence that we accommodate that consumers under that review, even where circumstances dictate that they're perhaps not eligible anymore for that review, no longer ripe for the process. I think we need to shift from that mindset. I think maybe engage a credit provider on how we can accommodate this consumer perhaps outside of that review. And we know there are other further bespoke solutions that all the banks have created for consumers outside of that review. So I think let's take the broader approach. Let's try and follow that 17.3 process where it's required that the court order be varied. And I think, you guys can have the discussions with each of the credit providers. But we do offer, concessions in debt review in terms of interest rate, in terms of installment, in terms of term. We then offer further concessions where we see consumers have been hit by external circumstances. At ABSA, we offer 3 months where the consumer doesn't have to pay anything back. But to take it beyond that, I think brings a lot of other questions to the table, and we need to start looking at the situation more holistically sometimes.
Sure. Thank you very much. Sorry, we just lost our light for a second there. The next question says, what are the respective banks doing to assist with CLI retrenchment claims for clients who have lost their jobs from the impact of COVID situation?
I'll take that one. I can't speak for everybody, but let's just, so there's a couple of things that consumers need to be aware about. And sometimes debt counsellors, you know, aren't necessarily experienced or qualified to deal with this kind of these kind of questions, and it does get complex because there is different types of insurance, and very often consumers are not aware of what insurance they've taken. You know, at the time that they're taking the loan, they're looking for the least or the smallest installment that they have to repay. So very often they rather go for the lowest, only death and disability, you know, as opposed to retrenchment and that kind of stuff. So I think that is something that we grapple with as an industry, and that consumers are not necessarily very well versed in. You know, whether that's whose fault that is also a question for debate. But from an F&B side, you can go onto your app, and if you go onto For Me, you can check your insurance. And I'm happy to send screenshots to the debt counsellors so that they can know where to go. But debt counsellors also need to be very very careful to make sure that when they are replacing insurance, that they're doing a like for like, so that we can ensure that the consumer is still covered. Because very often the consumer comes into debt review. If it's not on the DCRS proposal, we will cancel the insurance. And then the consumer comes back and says, okay, but now I've been retrenched, you know, what now? And the answer is, well, you're not covered because the insurance was cancelled, because it wasn't provided for. And so at that stage, you can't help a consumer. So we need to be very careful to make sure that when we are doing the debt review process, that we take CLI into account. And like I said, for debt counsellors, I know that's difficult because it's not something that they're well versed in. But if you are going to leave off the CLI off your proposal, please make sure that you have explained that to the client, A, that they won't be covered, or B, that you are contracted in with one of the debt counselling insurers. There are a lot of them out there. Some of them are very good ones, so that the client, in the event that they are retrenched.
Thank you. That was a great answer, Denise. I think we'll take one more question.
Shannon,
yes?
I think Lorraine's got a hand raised. Maybe
Sorry,
she wants to
Lorraine.
answer.
I just wanted to add to what Denise has said. So I think I can only speak on behalf of Nedbank, but our insurance department from the onset of the pandemic was actually one of the departments that has been extremely busy in terms of assisting on insurance claims specifically. And some of these covers do include loss of income, you know, as a result of a pandemic or something like that. So I just know from our perspective that we've received lots and lots of claims, and we've processed a whole lot of claims as well. So yeah, if the insurance is indeed intact, you know, there's lots of processes in place to actually process these claims. And yeah, maybe just from a consumer perspective, you know, to be a little bit more educated in terms of what your insurance cover actually involves, so that if something like a pandemic hits, that you know that you can actually lodge a claim for loss of income.
Okay, great. There, all of a sudden, a flood of questions. I'm just going to take one more, and then we will get back to everyone who's attended today with an email with the answers to the rest. We'll send those through to the panelists. With regards to annual reviews, should DCs ignore when consumers have less funds available? What's the moral obligation? And do annual reviews then mean annual amended court orders? Mohammed, your hand is up.
I actually seen this one in the in the chat, and I was busy typing out the reply. I think Denise mentioned it in passing, and a couple of the audience members got hold of the concept of annual review. So look, I think it's something we haven't yet fully pinned down from an industry level, right? It's at CIF. I think I urge all debt counsellors to get more involved. I think we have generally one big association represented at the CIF, and at other times one or two others. But I think the more DCs that get involved, either through your association or even individually, I think the more that gets involved, the better. I think we're looking for the ideal situation, the solution. Us as banks can't tell you exactly what's the right and what's the wrong right now. We're working together with the NCR and the rest of the industry to come up with an ideal, right? From a moral perspective, and I think it's also from a process perspective, if the consumer's income is dwindled and it's not as high as it was, then I think the right thing to do is to actually provide a new proposal confirming that the consumers earn less, and if he can't cut his budget more, then he's got a lower affordability to pay us. I think that prevents trouble and headaches later down the line where consumer short pays or misses a payment because of the financial pressure they're under, and then gets terminated. And we're having discussions around reinstatement of accounts when our product houses have issued summons already, which makes it very difficult for us as debt review department. So we urge you, if there's been change in circumstances, or as you find as part of the annual review process that things haven't come up the way it is, and there's been a decrease in affordability, let us know, and let's see if we can solve for a solution from that. I think Denise has something to add, so I'll stop there.
Yeah, thanks, Ma. I just wanted to answer the second part of Zach's cheeky question. Zach, no, we're not saying you need to amend the court order on a yearly basis. So remember, a client can always pay more, okay? I think what you are specifically referring to is a client whose circumstances has decreased for the worst. Then, we need to understand what the underlying issue is, because no, you don't want to keep going back to court. You need to understand, why is the client's position getting worse? And hopefully their position is not going to get worse every single year. But if you can see that this is going to be the case, then you need to make an arrangement with us that's going to cover, and I know nobody's got a crystal ball, right, guys? But the purpose of debt review is to assess how the client can repay going forward. So I think if we do a proper assessment when a client situation has gotten worse, to say, well, why is it getting worse? And do we foresee that this kind of trend is going to go on? Then what you need to do is you need to take that hopefully into account with regards to when you're doing that proposal. So we only have to do it once. And like I said, guys, I know it's easy to say, it's tough to do, but it's what we do every day. Every day we say, in 10 years' time, the client's going to be paying 100,000 Rand, or whatever the story is, right? We're using our crystal ball. So we need to make sure that when we're doing that, we're taking as much of the client's current situation into account as possible. Things like retirement and that. Okay, sorry.
I could also just come in.
I'm going to, sorry, Roxanne, would you like to say something?
Yes, thanks. Just to add to what Mo and Denise are saying, I actually sit on that CIF annual review committee, and it can get very interesting and to hear everyone's different opinions. But yes, to Mo's point, participation is always important, and there is no perfect solution to the situation. But I think the important thing is that we are constantly looking where can things improve, or if things haven't improved, let's rather deal. And there was talk about using obviously the 17.3 process in order to execute upon the annual review, whatever the outcome of that is. If it's worse, then disclose it to us through the 17.3 process. Explain the situation. Maybe it was, working less hours because of the pandemic, whatever industry they're in. I mean, we people at the bank, we're not just an institution. We take those things into consideration. And like Mo said, it's so much better to deal with it within debt review than renege on your repayments and then be terminated and have to deal with that. Also, annual review isn't just the case of lesser payments. the whole purpose is hopefully to see that there's possibly more affordability as one goes down the line. And then the benefit of that is to obviously pay off your debts faster, be rehabilitated faster, get out of debt faster. So, and I mean, that's what everyone's end goal is in the process, that we're all aligned on that one. So it is exciting. The annual review committee is meeting very regularly. I'll give that update. And it is a long and tedious process, but we are getting to the point where we're going to try hopefully streamline it and make it workable, and then to the benefit of the consumer at the end of the day.
Brilliant. Thank you. Last little point from me before I hand back to Drisha. I'm going to launch a little poll now, if you wouldn't mind taking our poll, not necessarily the panelists, but the attendees. And then if you have any ideas or questions that you would like to send through to us, Drisha is going to give her email address at the end of this, if you don't already have it. But also, if there's any particular topics you would like to us to discuss in these webinars, which we do quite regularly, please also do let Drisha know. Back to you, Drisha.
Thank you so much, Shannon. All right, like I said at the beginning, this was a very interesting topic indeed. I just want to thank our banking industry panelists for taking the time out of their busy schedule for joining us today. Thank you so much. And to answering all the questions. To our debt counselors, thank you also for joining, as well as your teams. Take care and obviously stay safe. The email address that Shannon mentioned, if you don't have it, is drisha@consumerfriend.co.za. Please also pop me an email, because I'd like to set up engagement meetings with you guys as well. So yeah, send through those emails. And like I said, take care, stay safe, and we'll see you guys soon. All the best.